Welcome to the Nuts and Bolts of Real Estate podcast. My name is Joe Bauer, and I'm here with my co-host Julie Clark. Julie, how you doing today?
I am super excited today, Joe. Today, we're going to cover one of my favorite topics, which is going to be more of commercial real estate and multifamily and commercial development. Not something we talk about all the time. So it's going to be a real treat for us today. So I want to make sure we leave a lot of time to talk to our new friend, Jake Harris, today. But before we do that, Joe, what's new with you?
Oh, we're just hanging out in Sedona, enjoying this swing season where every place else seems to be getting snow. We are in the 70 degrees riding mountain bikes on the Red Rock, so I cannot complain.
Is that the buzzword, the swing season? I'm gonna steal that from you, right? Swing season.
When the weather starts to get bad in the mountains or most places, we swing into the nicer weather.
So how long do you think the swing season lasts, or does it last? I mean, as long as you stay in Arizona, I guess it stays that way, right? When are
Yeah,
you
you
guys
could
gonna
keep.
swing over to the snowboarding?
We're actually headed back up north, or like the slow north trip, in the next couple of days, probably. So soon, but slowly up the Eastern Sierra.
Nice. Where are you planning? Sorry, Jake, we got to get all the activities of the outdoor world out of the way. Where are you planning your first snowboard experience, or we don't know whoever gets the snow best first?
Sure yet. Yeah, you might beat me to it this year. You never know.
Okay, well, I'm gonna try. I'm gonna
Nice.
try. All right, well, let's jump into it today because I'm so excited to have Jake with us here. I'm gonna let Joe, well, I'll just first tell you guys, Jake Harris, he is an author. He is the co-founder of Harris Bay, and his company focuses on commercial real estate development and investing. I'm gonna let him explain to you more so I don't butcher all the great things his company does, because he's got a huge umbrella company that supports all his commercial real estate activities. And we are excited to introduce you to Jake. So Jake, how you doing today?
I am fantastic. I am excited to where that snow is going to hit as well. I actually had a heliboarding trip scheduled last year that got canceled because I was out in Utah and Park City, and because the snow was not great. Previously, like the year before that, I was going to go to Canada, but COVID closed all that down. So I'm very, very much itching to get this bucket list adventure of heliboarding back in. And so it's exciting seeing the winter coming up again, and Canada's open. So maybe it ends up being in British Columbia or maybe somewhere over there. So yeah, real estate. I do lots of real estate. That's all almost I've done for the last 20 some odd years. Saying and kind of joking earlier, I'm kind of like, the dancing monkey. You put a quarter in me and I bang my little cymbals and just talk real estate. It's evolved over the years. It started flipping houses. Then we, kind of got bigger and scaled that up. So we did, something 1,300 flips in 23 states. We aggregated some single family rental portfolios and sold those off to the institutional investors, Invitation Homes, Colony, Tricon, some of the bigger fish. And then as we were also discussing earlier, I was like, I sure wish I would have kept even those homes. And that was my own natural progression towards getting into commercial deals was, we were doing all this volume. We were doing hundreds of millions of dollars worth of transaction. It was just like, why don't we just do one deal and do one $10 million deal that makes 20% return versus trying to flip a whole lot of residential. And so that was 7 years ago, started getting into commercial real estate. And I use a lot of data analytics to determine where we're going to invest. What I've found is to multifamily, warehouses to apartments, a lot of infill, adaptive reuse, redevelopments.
Well, what you say is interesting. So I've listened to some of your other stuff. And so your MO, correct me if I'm wrong, is that you lead your decision making. First of all, you're a big data guy, right? I mean, you're a big data guy, and we can talk about that in a minute. But your decision, I think you gave the Michael Phelps analysis I've heard on some of your other shows that you've been on, but that you pick a market and then you don't necessarily niche of, let's say, all just multifamily, 100 units and up or whatever it is, you take advantage of riding the tide of let you explain it yourself, of what's going on in that market, right? That you kind of take advantage of the fact that that market is going to naturally appreciate because it's of whatever data you've decided is the important data in that market. So you want to do as many deals as you can in that market, whether that be, office buildings or multifamily or whatever different asset classes those might be, mixed use, assemblage, new development, because you're riding the tide of what you believe based on your data is a market that will carry you forward by swimming with the stream instead of against the stream. Or you go ahead and explain it to us. I thought that was I haven't heard somebody kind of explain it that way before.
I appreciate that. And that it's like the tide, the wave, whatever you want to use that as an analogy. And so, yeah, it's versus, and the example I used is you can be the Michael Phelps, be world-class swimmer, or you can just be the person that, paddles like a little Grom on the boogie board in front of the wave. And you actually don't have to be a very good swimmer to actually effectively allow the momentum of that market to take you where you want to go. And so part of that was I ran, it's a fancy word, a regression analysis on a lot of markets. And so what happens is if you're just investing into a top performing market, you're like mostly the market does the heavy lift for you. And so when I identified these demographics as far as job growth, population growth, affordability index, and then kind of a catch-all of what is that makeup of the people that are moving there and the jobs, X, Y, and Z. And then I've actually added an additional layer to that is an infrastructure bond spend. So the government publishes what they're spending their money on, road improvements, streetcar lines, new park redevelopments, street, whatever. And so then layering all of those things in becomes a data set or kind of an analysis of a market that I'm looking at. And so when there's significant amounts of infrastructure spend on a market, it's going to get a return on investment. And obviously the government doesn't look at it as like a return on investment, but if they go spend $100 million redeveloping Central Park, or, Joe's Park in that particular city, that ancillary real estate around that park is actually going to be a little bit improved. And
right.
So that streetcar line that gets put in for $100 million, well, then we look at that and we start mapping these things out. And so when I'm looking at it is, okay, I've identified that this 3-mile radius or this downtown or this urban core is spending a significant amount of money. And then there's private development that's following on top of that. So we're identified the market first, and now we just have to find a good deal in that particular market. And so that's why it has to be, and I was going to say, it's just like, sometimes it's office, sometimes it's land, sometimes it's an apartment. We're identify that market first and foremost is going to help move the values up.
Let me ask you, so you're identifying a market, let's call it, you identified San Antonio, and what is that, Central Texas, as the market. Now within that, now you've selected San Antonio, you guys, it sounds like, correct me if I'm wrong, that you guys are niching down within San Antonio are you guys niching down to a specific, like you said, 3-mile radius off of some other data point? Like you said, the infrastructure package is being spent, I don't know, in some urban village neighborhood of San Antonio. And so therefore, are you looking just to pick up properties within that certain radius of that urban village, like in Seattle area? Let's just say that could be, guys, it could be more like Crown Hill in the Ballard area had an up zone, right? It's not all of Seattle, it's the Crown neighborhood, it's the Crown Hill neighborhood, or the Roosevelt neighborhood had an up zone. And therefore people are focused on that radius around that urban village within the city of Seattle or San Antonio. Is that your MO, or are you looking citywide? Is it just getting specifically deep dive detail on you there?
I like, much more the niche of those neighborhoods, a district, an area, because again, as we identified, so in one of the things that's happening is the country as a whole is revitalizing their downtowns. And there's this urban renaissance. People actually enjoy being able to walk to the coffee shop and a restaurant, and even where Joe is, like downtown Sedona is super rad. Like there's a bunch of restaurants, you can walk to most of the stuff. Like what people want is the same kind of the world over. And so fortunately, I've been blessed to be able to travel and experience some of these things. Is like people, or in most cities, were designed for people, not designed for cars. In the United States, we've done a really good job of designing for cars for the last 50, 60, 70 years. And so as in the 80s and 90s, a lot of the downtowns of these secondary and tertiary cities what they called white flight. People moved out. Well, now all of a sudden they're coming back because they're like, wow, this density of activity is actually a benefit. And so that's where we're seeing a lot of these infrastructure spends or redevelopment and catalytic redevelopment projects that are helping to change some of these neighborhoods. And then we're seeing a much a bigger thing, like you just mentioned as well, upzoning or rezoning or dropping parking requirements, or a lot of those other things that we're going to see an increased valuation and the vibrancy of neighborhood. And I think it boils back into, is what I really like, is community. I like people giving a chance to meet other people. Of course, it's actually relatively easy to do greenfield development, to go build out into the sprawl and say, here's 100 acres and we're going to build, 250 homes or 300 homes or whatever it is. And we're going to put in all brand new infrastructure. That's the Jamba Juice's Starbucks, cookie cutter production home. That's not what excites me. What excites me, and also what I see as the future of these investments, is doing things that are a little bit harder. So like redeveloping in a particular neighborhood, taking that historic building or that house or whatever and turning it into a higher and better use. And so exactly what you said, I say a 3-mile radius, and I actually have some lines like, I don't want to be on that side of the freeway because of X, Y, and Z. Sometimes, and it's difficult, but that might be where the detention center is, or a homeless shelter or something else, and be like, what, I don't want to be there because we're combating against some other things. In 5 years or 10 years, let
me ask you some more questions here. So some investors, right, and maybe, I don't know, because you're willing to take on different asset classes, right, of projects in the zones that you want to be in, so I have some investor buddies. One of my best groups that I love the most is Spartan Investment Group. They focus on self-storage, right? But that's what they focus on. They're not buying office buildings or multifamily and mixing it up. And so I hear a lot of investors also say, I want to go 1 hour. I'm focused on investing 1 hour out from the hot zone. I'm saying that you're investing in the hot zone, right? I would think on commercial real estate, your business that you're in, that is the most competitive area for you to be investing. You're investing in where all the other big boys and big gals want to invest, right? So my question to you is, how do you compete on your deals? Are you conservative? Do you take risks with your underwriting? How do you compete in a market that is, like you said, spending a bunch of money and going to be an urban village area that probably a lot of the institutional investors want to invest in? How do you compete? And how do you, not only while you compete, how do you stay conservative with your underwriting while you're competing and still be able to get it?
Just usually it's my boyish good looks. I give
I
a wink
so.
and a nod, and like wink, wink, nod, nod.
That,
just give it to me for cheaper. No, what it is that, so what's interesting, and I mentioned it earlier, we invested into Austin before all that institutional capital came in. And when it came in, we couldn't find a deal that made sense to our underwriting. And I do have a little bit more of a conservative approach to an investment because I got, ran over in the subprime meltdown. I was speculating on future value. So if something's worth $100, I'm not going to pay 105 hoping that it goes up to 110. Like, I'm always building in a margin of safety on my investments. And that's why I was like, we kind of primarily invest in these secondary or tertiary markets. And I call this the mafia rule. Is there's typically 5 families in that particular market. And they tend to be, in San Antonio, there's 5 billionaires. Is they have an investment criteria that they kind of do. Like, they only do this area. They only do hotels. They only do self-storage. They only do self-storage. Great. Spartan only does self-storage. So guess what? I can go do a deal right next door to Spartan, literally right next door, as long as it's not self-storage. And so what I do is I identify, like, what do all these other people play in? And so then I know that here's this giant gap, or the fingers in which no one else is doing those particular deals. Seattle, California, there's just so many people. You have 30 people that do exactly the same thing that I do. And so it's like, but in San Antonio, there may be only 2. And it depends on where.
I get it. I get what you're doing. So you're going into these markets, you're identifying who the big players are in those markets, as well as, the data points on the infrastructure spends and jobs and all that other stuff, employment base and people, probably population moving in, all the normal data points, any top-notch commercial investor would want to be adding to their due diligence and their research. And what you're doing is identifying who the big players are, what they do, what their specialty is, and then you're going and buying up the rest. They've already, you think about it, like you said, the CBREs are probably leading the charge of all these guys. It's like riding on the coattails of the big boy research from CBRE. They go in, they help these big 5 billionaires pick the market. They've chosen the market. They're there to buy their specific asset class, whether that's, big institutional multifamily investors. They're not going to want to buy anything that's probably less than 150 to 200 units, right? So that leaves below that. The, office guys are going to be buying however many square feet of office space. So there's whatever that are, below that. Like you said, it's kind of like the old Tully's and Starbucks model. Probably, I don't know if it was Tully's or Starbucks that let the other one buy it. And then the other one would go build the one on the other corner. Right. So you're letting them lead you with all their research. You're doing your own research. You're making sure there's not too many of them, or that there's a place for you to fit in, since you don't have to have an asset class necessarily specialization, riding their coattails, so to speak. Is that kind of a quick and dirty?
Somewhat. And so what I would say, there's another caveat that I put to that is because there's a lot of cities that exist out there that are never going to see institutional investors. They're small town. I don't know if New York or institutional capital is going to invest in Shreveport, Louisiana. I don't know. I don't know much about that market, but what we also look at is one that's potentially emerging into an institutional quality investment market. So what would be an
example of a market like that? Why would you think a market is potentially going to?
So for instance, why San Antonio, why I identified it, and it has maybe a shorter fuse to that. Like, they did not have a CBRE office there before when I started investing there 7 years ago. And then they reestablished an office and now have been acquiring other brokers firms. Texas is unique, it's a non-disclosure state. So the information of what deals transacted, people don't know what those actual real values and those data are. CoStar sucks in Texas. It is garbage from an information standpoint. It's only, and all that information is housed within the brokerages. And so CBRE had no idea what was happening in San Antonio. Those 5 billionaires that know each other had an understanding of what was going on, but you didn't have any outside perspective. The New York and the Blackstones and these big firms just had no idea what was happening in that market. When the CBRE started building out and JLL opened an office or acquired these others, now all of a sudden they got really smart really fast because they had the data. And then what happens is you then start seeing people that are exiting out of these low cap rate markets. So for instance, like Miami, you didn't reinvest in Miami, you reinvested into St. Pete. well, Austin, you go sell at a 3 cap. Do you go buy back at a 3 cap? No, you go reinvest at a 5 cap in San Antonio. And so same thing, San Francisco to Sacramento. And so I like these having like this close relationship to a major metro that people would maybe exit out of. Chicago to Milwaukee. So it was like, oh, that makes sense. It's on the other side of the border. There's money and flight of capital to those particular markets as people are looking or trying to 1031 exchange or do something. And that becomes that natural progression. So as Austin became a little bit hotter, it gave it like a 10-year preview of what the potential of San Antonio could be. And so then we look at that so as we aggregate these portfolios and holdings of commercial real estate, when those institutional capitals or investors come in, we now have assembled together a hard to put together piece of property. They'll pay us a premium for it. So not only did we get good cash flow while we owned it, but we also get a compressed lower cap rate, and we exit and make a lot more money when we do decide to exit out of that.
Makes sense. Well, that's all good stuff, guys. This is all due diligence type of stuff, which is, I don't know, how long is your due diligence checklist?
I think it's 64. I have a checklist of it that I use and go down. So there's 64 points in which I go through on an individual property, but there's a lot of that, like I said, market analysis things that I'm doing ahead of time that is just an aggregation. And people are like, where do you get that data? And I was like, everywhere. Like it's from census data track. It's, tracking into the cities and counties, bond spend stuff. It's a very robust way of looking at data. And I wish there was a way that aggregated all of it, but it is just a lot of research.
I got something, a give to you today. You should go on the Spartan Investment Group website, you can download their due diligence checklist, which is like 170 line items long, as a free checklist. It'd be fun to compare what they have on their checklist. I was just with Ryan Gibson this weekend at a real estate conference where he covered the topic of due diligence, and that's downloadable off their website, you guys, look at that. I know, don't you have some sort of due diligence course or something, Jake, as well?
And that's part of it, because so many people last couple of years were like, that's it. I'm not going to flip houses. I'm just going to jump into these commercial deals. And there's, as you know, Julie, there's a lot more complexity to a commercial deal, and there's ways in which you can get in trouble. And if they were just
different pond, I call it the Peter principle. Oh, I'm good at flipping houses, so now I'm going to be a home builder. Oh, I've killed it as a home builder. Now I'm going to buy or start building townhomes. Now I'm going to start building apartments or try and jump into commercial. It's like a different language, right? So there's a lot of mistakes, and not only the mistakes are bigger, the cost of those mistakes get larger as you jump into commercial, but so does the upside. But don't be afraid to do it. You just got to get your due diligence stuff checked out. Well, I want to back it up. So how did you first, I know that, you were flipping a bunch of houses, and you say that you started selling those to the Invitation Homes, or, I don't know if that's the story. How did you get involved? What was your first involvement with some of the institutional players? Me, myself, I have done business with both Invitation Homes, Wedgwood, so forth. In the flipping world, I would sell them properties one-offs, unlike you, probably amassed a portfolio and, like you said, maybe sold them off a portfolio. But tell me, what is your interaction with institutional players, and how did it start?
I had lots of touch points of that. I don't remember what was the first introduction to that, but there was a coming up from LA, and they partnered with one of my friends as far as starting placing capital. They said, we have a $25 million fund. We want to start buying single family homes and keep them all as rentals. And so, we'd hang out at the office, and it used to be like 4 guys in an office, and the dog was there, and you'd lounge back on the couch. And then all of a sudden there's like, here's $25 million. You got to go spend to buy these bunch of these rental properties. And
So
I was
were
like,
you working for that fund as an acquisitions guy, or what were you doing?
no, I just knew of them because we were friendly competitors. And then as we started growing, they started making offers on our portfolios. And I was like, yeah, no. And then they just said, hey, we'd like to buy all of those houses, or will you sell us 10, or will you sell us 20 of them, or whatever, because we just have a bunch of money. And then it was kind of like, well, maybe. And then we were like, well, if we'll sell you these 10 at this price. And then they're like, great. And they closed for cash and like on Tuesday out pretty well, like, maybe we'll sell them a few more. And then Invitation Homes came into the market, and they interviewed again, some other friends, some other people to run their local operations. And then they wanted to buy. I actually became a vendor for them. My construction company started fixing up because they like sucked up the entire market.
Yeah.
They bought everything because they had $1 billion, not 25 million. They're like, we're buying every house on the market, in the auction, on MLS. And so all of a sudden I was like, oh man, how am I going to make any money? So I was like, at least I should become a vendor for these guys. And so I did a lot of remodels. And I'll tell you this interesting story that I had. It was kind of like this moment of like, I don't understand, like my brain hurts. So I bought a house, I fixed it up. We standardized, and what we would do was for an investment is make everything kind of new paint, new carpet, new cleanup, everything functioned. But it wasn't, we didn't do everything, but it was like everything functioned and was in working order. So we spent $25,000 fixing up. So we're in it for $200,000. We sold it to them for $250,000 or $275,000. Well, as part of this kind of portfolio, I got a work order as a vendor from the contractor, or from this institutional Invitation Homes, to go fix up the house that I just fixed up.
Right,
We sold it to them for $275,000. And then they said, hey, here you go spend $25,000 fixing up this house. And I was like, hey guys, maybe there was a mistake, but this house is literally brand new, all new appliances, all new paint, all new carpet, all new flooring, all these other things. And yeah, they say, we don't care. We want our finish in there. We want our appliances in there. We want our paint things in there. I was just like, this is stupid. Like, I was like, I don't understand. So I bought it for $175. We're in it for $200. We sold it $275. Now you guys are going to be in it for $300,000. It's worth $275. That we sold it to you top of market. I was just like, I don't understand what's going on. Like, how it doesn't make sense. And so it took me a while to figure it out. And so what happens is they were using as like that particular asset they're using is like, they were willing to pay up to 75% of the previous peak price. So if they said that house at one point was worth $500,000, they're willing to pay 75% of that value, be all in on that number, because they felt like it was going to shoulder off of that previous price and go up even beyond that. And so
they're going to hold it long term.
So they did that, and they were billions of dollars, $9 billion correct. I did what I did, and I was micro correct, and I saved 25 cents a linear foot on the baseboard. And so I saved and made an extra $250. They made $9 billion. And so that was the big like epiphany, like, oh crap, I need to be thinking bigger, doing bigger deals. I suck. They're smart. I'm not.
Was your epiphany moment? So yeah, I used to add access to the back end of the Invitation Homes, like could see everything that's going on, mainly more like to make sure I knew what the rents were and stuff like that. I still use the Invitation Homes site today when I'm looking for rent comps because they have so many properties. But when I was underwriting for Invitation Homes to sell them deals, I knew that it doesn't matter what it looked like. They had their standard paint. If the hot water tank was more than 8 years old, I know it was going to get replaced. So they, why they did that is because they only have money in the beginning. So Invitation Homes, which is an institutional buyer of buy and hold properties, guys, I think you might know, look them up if you don't know who it is, but they only had money, to my knowledge, in the beginning. So their budget, once they owned it, they did not have a budget anymore. So they had to standardize everything because they had their inventory of supplies that they would, get at their cost or whatever. So they would standardize everything on the purchase. So you'd wonder, okay, well, this house is painted with some other color walls. It's perfectly fine inside the house. Nope. You had to budget that they were going to paint that. Certain things, right? You had to budget that you were going to convert that house into their standard and build that into the underwriting, knowing they were going to go ahead and do that so they could still make their returns. Interesting stuff. So you were working to kind of opens your eye to greater, getting into bigger deals, right? How did you transition from being the guy that was doing their construction vendor, buying your first? What does it look like when you bought your first commercial deal? What was it? Where was it? Why was it? And how did you pay for your first commercial deal? Or were you an asset manager that got a piece of the pie for running the deal? That's how I got started. I was the asset manager that got a piece of the deal to be the operations, basically partner of the deal for the big boys. So they used all their money. They give me a cut of the deal because I would basically go execute the plan. I would even tell them the plan, but they'd pay for it. And I was the asset manager. How does that work when you got started?
So I would say the first kind of deal like that, we just put together. Actually, I had an apartment in New York for a little while with my wife and our son, Hudson. And it was right in the Murray Hill, Madison Park kind of area. And so we'd walk over to Madison Park and hang out and play in the park there. And that's where, if you know New York, that's where the Flatiron Building is. I love the Flatiron Building. It's a super cool, architecturally significant kind of building. And I just remember standing there and like looking up at the building, and I was like, that's cool. Like, that's such a cool, iconic building. And you can also see the Chrysler Building from right there and a couple others. And I was just like, and then it just dawned on me, like, as I was standing there looking, I was like, somebody owns that building. Wonder who owns that building. And so, well, fortunately, we have a Google machine in my pocket. And so I was like, who owns the Flatiron Building? I started like researching, and it was like an Italian investment firm or something like that. And they own these super cool, iconic buildings. And I was like, I want to do that. I want to own iconic buildings like that. I want to own these cool things. And there was a commercial deal in downtown San Antonio that looks kind of like the Flatiron Building. So it was built in 1902 as a similar kind of architecture, and it was on the market and had been on the market for a long time. And so I was like, try to buy that. I don't know how I'm going to buy it, but what I did is, so I, negotiated, a good purchase price. And then I went out and then raised some money from some investors and said, hey, we're buying this building. We're going to, modernize this office building. So we're going to put in new fiber internet. We're going to upgrade the elevators, and it's, tired 1980s interior, and we're going to improve it and reposition it from there. I know how to do this because this is what I did before when I worked for Equity Office Properties. Is I would do the construction work and fix it up. I know how to do the value add part of it. So this is what I'm going to do, and who wants to invest with me? And so I think I raised $1 million to buy a $4 million office building. And we still own it today. It is, a commerce building on downtown San Antonio. And it's kind of what we're using as our logo for some things. And it's like, I may the cards, play out as they may. And so that was just the deciding to do it.
So you're a hustler, you're an action taker. And I mean, in the sense of you are a guy that decides, I'm going to do this, and then you go do it. And you knew you had the knowledge and skill set to do it. Maybe at that time, I wonder, for your very first deal, because people are listening to this, right? And they're like, that sounds like me. I want to get into commercial real estate. And I'm here. You don't have to. Flipping houses is a day job. It's a way to raise capital. It's not cash flow. It's simply a day job and way to raise capital. I love brokerage, right? I raise capital or chunks of money by doing brokerage, only because I love it. Other people might love flipping. That's their way of raising some capital, but it's not going to grow your wealth. It's not going to get you anywhere other than give you some chunks of money, right? It might not even pay your bills. I mean, cash flow is king. So for people listening, you guys need to understand, if you dream of doing better and bigger and better things, you can start there. Don't need to start, in the small pond and work your way up. You just learn about the big pond from the beginning. So Jake, you're going to identify this building because you have had all these years of experience. You know how to underwrite deals. You know the construction numbers because you're construction estimator and construction company or whatever in the past. But the hard part is maybe you've seen how the deals have been put together, or you've been involved from whatever you're doing before, how the financing works, right? But you go to do your first deal and you say, I'm going to go after that deal and I'm going to put it under contract. You're not raising the money first. You might not even, maybe you have relationships that you think you can raise the money from, but what did you do? I want to just go super backwards here. Did you look at that building? You call the brokers, right? You go on the tour, whatever you do. How did you make that offer? Did you use an LOI, or did you use a broker to write up the offer for you? What did you, or even today,
Yeah,
do
so
you write LOIs or do you write offers?
Oftentimes I send LOIs today. You know, part of that is having some conversations. I am a broker, but I don't use it. I'd rather use the broker that's listing it, because that small additional fee that they can make oftentimes is the ability for them to get the deal or
It's
not get the
incentive.
deal.
Yeah.
Yeah. And so, go meet with them, go talk with them, build relationships. And so I went in and, the guys that had it listed and said, hey, I'd like to tour this building. I'm interested in it. Can you tell me why it hasn't sold or what's the issue with it? And it was a dentist that had bought it, 30, 40 years ago, and he probably paid a nickel for it. And then he passed away and his kids owned it. One, I actually think, lived up in Seattle, and the other one lived in Hawaii. And they hadn't been to the building in 10, 15 years. And so they put no money into any of the TIs. So a tenant improvement. So they're basically told the tenants, as is, take it. And so they were below market rents because they were unwilling to spend any money into fixing it up. And so that created a very significant story for me to be a value add component. Is like, I'll sign new leases and I'll fix it up. And actually,
Right.
I think we can do that for X, Y, and Z. So I put it in contract and I said, hey, let's submit this offer and we'll put it in for, I think, about this price. And then
I want to back it up on you though, because value add real estate, and we understand those are deals that everybody wants to go after, or a lot of people want to go after that aren't, looking for Class A stuff necessarily. What I want to help our listeners understand how to take that first step. You got to have the personality to be a go-getter and an action taker. Number one. Number two, right? I'm going to really get micro on you here, Jake. When you call up, maybe people are scared maybe to even call up the brokers because they've never done a deal before. So you're maybe using a broker, right? Does that broker team on the listing side, do they say in the beginning, you say, I want to tour the building. They say, well, who are you? Do you have any experience? Or the brokers just call up and say, hey, I've got a client that's interested in this building. We want to arrange a tour, right? Is it more of like that, you don't have any experience? You have your experience from how you've worked in the past, but you've never done one of these deals. You've never closed on one of these deals. You don't have probably the equity in your bank account to close one of these deals, but you're going to call up a listing agent, or you're going to work with a broker that's going to say, hey, my client wants to tour this building. It's as simple as that, right? It doesn't need to be intimidating. You probably, people listening, maybe just need to find a broker that's willing to actually take the time when you're new, right? When you haven't done a deal before, that's actually willing to spend the time to tour you on these buildings. How do people get over this initial, I know it seems like a small question, Jake, but that's how.
No, and I'm glad you asked it, because I have not had that issue of being intimidated to reach out to a broker to go tour the property. I move and present myself as if I can buy $1 billion building. I just, and the money exists out there. I just have to go find it and collect it.
But the point is, they're not asking you to prove that you can buy the building when you call up. Okay.
Yeah. And I'm going to give you an example. There's a book, Richard Branson, I think it was called his first kind of like an autobiography. I don't know if somebody wrote it on him, or it was like Losing My Virginity or something related to that. And he talked about when he was 20 something years old, he wanted he had aspired to buy an island. And so he reached out to this broker, and the broker was flying him around in a helicopter to these different, like, islands, the British Virgin Islands or something like that. And then he kind of like realized like the guy didn't have the money. Like he was like, well, how much? Like they never even asked those questions. Like nobody asked you, like, do you have that money? And that's the other thing is like, I submit an LOI. They don't ask for proof of funds. Be like, I don't have the funds yet. If it's a good deal, I'll go get the money. And obviously now I've done $20 and $30 million deals. And I was like, I'll figure out how to get the $100 million deal or $200 million deal done. And so you just present it that way. So you don't need to show that you have an LOI. You don't need to show a bank account. You don't need to show a proof of funds. You just act as if. You need to show
confidence.
Just say, hey, I'm ready. I'm interested in buying this building. And especially right now, as the market's pulling back and activity slowing down, you may get the junior person on the team. Right now, the managing director of the things like, what can I do? How can I help you out? What's going on? We're doing nothing because there's no transactions. We got lots of time.
Let me keep going with you because we're deep dive. So I want to keep on the right track here. So now you're like, okay, I toured this building. I got in there because I acted with confidence, like I had the right and that I'm going to execute this damn thing. And whether that's through the brokers or calling the listing broker directly, act as if with confidence, people. Next thing, right? You either are going to write an offer or you're going to write an LOI. Let's use an LOI, okay, for purposes of this example. How do you determine? You're going to use your underwriting. You know what price. We're not going to focus on what price you're offering. Although, well, I'm going to skip that. I was going to say, do you always offer low and expect a counter? But let's skip that for now, okay, because we're in a different market. How do you decide, one, how much earnest money to offer, or what are the components of your LOI? Right? Price, earnest money, due diligence period, meaning your sort of inspection period for you flippers, due diligence period. How long do you get to study the building? Your closing date, right? What are the components of an LOI for you?
Yeah. And so I would say it very much varies depending on the asset. So like land, sometimes I might want a year of approval process to get something rezoned.
Let's go for a multifamily building because that's
and that's also where the market determines that. Like a multifamily is a lot more competitive, and if it's a good deal, like they're not going to give you 180 days. Yeah. You're like, you might not get 60 days, and so that has to do in that. I try to do those in conversations with the brokers. Where and if I can ever talk to the seller, that's the best thing is just asking questions. And so I gave this an example the other day. Is like one person actually was not motivated by the highest price. And actually I had a friend that just did a big seller carryback deal with the guy because all he wanted was, he was like, hey, I'm getting older. I just want a certain amount of cash flow coming in every single month. And so people were offering him more money, $3 million, $4 million. And he was like, that was not what he was interested in. He was not willing to sell. What he wanted was $15,000 a month on a property that was cash flowing $30,000 a month.
Right.
He just didn't want the headaches anymore. And so that's why I go, if you can talk to the seller, if you can't talk to the broker, try to get the information. Where's their pain point? Are they just willing to move? Are they more sensitive on price? Is there timing? And so it's like usually price or terms. And so, and sometimes if it's blind, you're just sending out an LOI, you may just put a lot of things in there, a very long time period, a very low price, lots of caveats to get out of the deal. And then you submit it out and see what they respond with.
Push back, right.
Yeah. And then
so the components though, the components of an LOI would be what?
Price, your due diligence time period.
Inspection, guys, where you're going to study if the property works for you for what, for your goals of the investment.
You may say, hey, you may think that you can get $20 triple net on a building. Well, you want to test that out while you're in due diligence. You don't want to wait until you close on it to find out if you're going to get those rents. So that's why the more time period in which you can vet these things out. And I would not be afraid of going into escrow. I actually just had a conversation with somebody that called me up. I go in escrow. Because guess what? The deal becomes very, very real when it's in escrow. You treat it like you're spending $5 million or $10 million. But guess what? If you've structured your contract and your LOI or your PSA or, whatever that is that you're using in the right way, you can walk away and get your money.
Talk about that for a second. So somebody might be going, oh, well, if I go into escrow, right, for however long I can get, I still have to make an earnest money deposit to go into escrow. Tip being in commercial real estate is write your earnest money to be due and payable upon approval of your due diligence period, right? What do you, I mean, for you, if you're getting started out and you don't even have, how much do you decide, first of all, let me even back it up, to offer for earnest money? How much do you decide? It's part of the story, talking to the broker, what are they expecting, and try and get that answer out of them. Otherwise, if you're flying blind, Jake, what do you offer for earnest money? Come up with that.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
It depends. And I would say, I don't have like a rule of thumb that I go, oh, we're going to offer 1%. That might be this closest to the thing is that we do. But again, it also, the market determines if it's fallen out of escrow a couple of times, or it's, they may want a bigger earnest money because they want you to go more money up and show that you're real, and it goes hard at a particular point. But I would say on average, I'd say a 1%, $5,000, $10,000, $50,000. Obviously it depends on the deal size. It depends. And sometimes I've actually used very big earnest monies, but then made it very, very difficult for that to not be returned to me. $100,000 on a $100,000 deal. But like, if we walk away, after, so it's the contract becomes very important from that, but it showed to them a certain amount of strength and they were willing to take a lot lower price because we were putting a higher earnest money. And so every single one of these components has a psychological effect to it as well. So if you go, hey, I'm going to put no money down, but I'm going to have all my due diligence done in 30 days. So you're going to know if this is a deal or no deal in 30 days, but I'm not putting a bunch of money down. And most of these owners, I would say it's not taking advantage of them. They're oftentimes, and people in commercial real estate tend to be a little bit more sophisticated than the residential kind of world. They know what you're doing. They read a contract and they go, yeah, I know what they're doing right now. I have offers all the time that people try to do stuff. And I'm like, I'm not doing that. I'm not giving you a free, 3 months to tie up my property. And then if you walk, I get nothing. Here's my component. I'll give you that 90 days, but it's going hard in the first 15 days or the first, whatever amount of time. And so you need to be very proactive. That's the other thing that people don't understand about commercial is your due diligence cost money. Right. It can cost $50,000, $100,000, $200,000 in due diligence, from engineering reports and inspection reports and asbestos reports and phase 1s and phase 2s and a lot of those other things. So it's like, I don't say go do that willy-nilly. If you don't have the ability to go lose $50,000 or $100,000 on tying up that property, then you're probably not playing in the right game. is that possible to, raise capital and get those done? It's like almost every deal that I put in escrow, I've closed on, other than like having a material fact of we discovered some contamination or something like that. I go into escrow with the intent of we're closing this.
What are you using though? Like if things are pretty clean on the deal, let's say it's a straight over tackle deal, what are you using for your, I mean, I know it's market by market and you're talking to, it's like any other lead, guys. You're going to listen to the story of the seller, what their wants and needs are, or what the broker is telling you their wants and needs are, and you're going to build your offer or your LOI around that, right? If you get no information, like Jake says, maybe you go in a little hard and low and let them just counter you back, right? So you're understanding and getting the information in that sense. So let's say you're somebody that has to raise money. At what point in the process do you raise the money, Jake? Are you raising, if somebody's getting started, you have to have a deal before you raise money, right? Or how, at what point? You don't know necessarily that you have the money raised before you go into making that offer and get under a contract. That can be a scary idea for some people, right? You're saying go ahead and get into escrow and then raise the money later if it's a deal. Is that what your message is, or what?
Can be. It depends. So, and everything depends on your ability to raise capital. I think most people overestimate their ability to raise capital. And I'm going to give you an illustration, and it is the story that hit me over the head like a 2x4. So I still to this day have an aspiration to do a skyscraper, a high-rise development project. And so I went to grad school down in Miami at FIU and studied and got a degree in international real estate and in finance. And so like I have a little, a leg up, and obviously, we talked about this earlier, 20 years of experience of doing these and doing lots of hundreds of millions of dollars of transaction. And I was just like, hey, when I do more, then I'll be able to have the experience and the accolades to go do a high rise, a 30, 40 story kind of building. And so I met this kid, and I say he's a kid. He was late 20s, maybe early 30s. And he had just finished building this 42 story condo project in Miami Beach. And he made like $30 million profit. And I was like, wow, that's like my dream to do that project. And I was like, wow, like, tell me, did you have a lot of experience doing this? How did you do this? Did your dad do it? Did you, inherit a bunch of money? Did you? And he came over, and I believe he came over from Venezuela. And he's like, I just came here 5 years ago with no money. I've never done construction. I don't even know my dad. I've been part of the thing. I came to America because this is the land of opportunity, and Venezuela is kind of, terrible. And so I came here, and there was a piece of property listed on the market. And I talked to the broker, and I put it in an offer for what it was listed for. I had no money, no capital, no experience. And then I just went down the street to the one that was next, that was already being built. And I talked to the broker that was listing those sales, and the construction company and the architectural firm. And they said, hey, we have a lot of demand. We can do that on your parcel too, and just do the exact same thing. And actually talk to the broker because they were doing really good on the sales. So they went and talked to that. And then they said, oh yeah, we have a pent up demand of people that want to buy these, and we can help you. And here's 50, 80, 100 contracts for someone to go buy, all these units of the building. And then what happens is it all kind of came together. So he only had to raise a small amount of money. He's like, I have all these sellers. I have these things. And the bank was like, yeah, we'll finance it because
he had a bunch of pre-sales.
It had all these pre-sales. And so the very first real estate project that he ever did in his entire life, and his in first few years in the country that he came in, is he built a 42 story high rise, $100 million plus project where he made $30 million profit. And so I was just like, shit.
Take action. Yeah.
Like taking action. And I go, everything is a construct of imagination. The building that you're sitting into, or the downtown in Sedona, or wherever it is, you look like just somebody decided at one point that'd be a good place to put a building there. And then they just had an idea, and then they convinced other people. Like, people actually don't believe the numbers that you tell them. They don't have to believe those things. They just have to believe you believe it. People just believing that you believe that, they'll invest into you because they believe you believe that. Well, they don't have to believe that transaction.
The money finds a good deal. So go get yourself in a deal, right? Maybe it doesn't even have to be a great deal. Maybe, just go take action. I think the message of today's podcast is, take action with confidence. If you want to go buy commercial real estate, then go fall forward, be imperfect about it, and make sure you have your backstops, make sure you have your outs, right? So you don't hurt yourself, but fall forward with confidence and take some action, and you never know what can happen, right? You get a deal under contract, like you said, go figure it out after that. I'm sure Jake would be willing to talk to you guys if you got a deal under a contract to help you out with that. I know I would also be willing to talk to you guys on that stuff too. So we're going to run long on time here, Jake. So I want to ask you, what do you think, first of all, what's the hardest challenge you've had to overcome in your development or real estate business, and how did you overcome it? Like, what's the biggest hurdle you've ever faced? Personal, like starting, but like in your, we good operators based upon not all their wins. As you said, you could follow the tide rising that takes care of, a lot of problems. What problem have you actually had to face in your deals, and how did you over?
I was like, all of them. Everything's hard. And I was like, so that's the disillusionment that I think people have, is that they think something's going to get easy at some point. And I love the Stoic philosophy. I love Ryan Holiday's books. And I think obstacle is the way. Is life is an uphill journey. If you're actually growing and pushing yourself, what you're doing is you're evolving up from level to level to level. So, think of it like a video game, or at least that's the way it made the most sense to me, is like you needed to gain enough XP to go to the next level. Well, what happens is if you just stay at the existence and your comfort level, is you're just going to stay in the same level. You might be a level 3 in operations. And so, but what happens is you have to push and get different challenges. And so at different times, was raising the money. Well, raising $1 million was hard at one point. Well, now that's not as hard. Well, but now it's 5, and then it's 10, and then it's something else. Then the operations become hard. Then the systems become harder. And so again, just failing kind of forward. And I think the other thing, as far as like the topic, is like, ideas are shit. Execution is everything. And done is better than perfect. And so just something being done is better than perfect, your plan, and then your ability to adapt and overcome. And so I am constantly learning, being around other people, how you operate, the property management side of it, the systems that you have in place, I think is always very, very impressive to see. And I learn a lot from other people, and it's evolving and growing and growing. And so just because you do one particular thing, well, it doesn't mean that you can't evolve and grow as a business. And I think as an individual person, I do some core things, or the things of who I am, really well. And I do lots of other things very poorly, and I suck at them. And I go, so I can ignore those as on a personal level, but in a business, you don't get the ability to ignore the things that you're not good at. You have to improve those, or hire them, or put systems in place to make an up for, because you need to build, especially if you're taking outside investor capital, is like, you're going to need to get better and better and better as you evolve from that. And so then there's always going to be struggles. It is a uphill journey the rest of your life.
Good answer. That's a good answer. We're going to wrap it down here. Give me 2 more minutes. Last question for you. Based on where we are in the market today, or, maybe it's a double-edged question here. How have you changed? Like, if you're making an offer tomorrow or today, how have you changed your underwriting today based on current market conditions, or what you expect the market to be in the next, with commercial, you're looking, probably when you buy a value add deal, you're looking 24, 36 months down the road to when you need to refinance, or when you want to refinance and get your permanent loan in place and, get as much cash out as you can, or whatever, for your long-term holds. how have you changed your underwriting today to continue moving forward, making offers? Or what do you think is looking forward in the next 12, 24 to 36 months, which is probably the timeline when you're doing commercial deals, if not longer, you need to be thinking about for the financing, right? On the other end of it.
I think, and one of the things I talk about, even in my book that I talk about, is having your business plan. What your timeline very, very much matters. And we talked about this earlier. Invitation Home was playing a very long game. So their business and your underwriting depends on the game that you're playing. If you're looking to flip something in 6 months or stabilize it or do something like that, your underwriting is going to be very, very specific to that particular asset type. And as far as if you can't take the burden of 8, 10, 12% interest rate on a deal, then you need to appropriately discount your deal to where it can handle that, because that's going to be the interest rate environment for the near term. And maybe in 2 years or 3 years, it's lower. And so then you just take the factor. And so if you're like, I need to be able to carry this project during these timelines, well, guess what? We need to make to stress test that to say, what if it's 12% interest? What if it's floating on X over, SOFR, or, whatever those things are, is to model those things out so that you can appropriately toggle. Where it might be a land deal, we're paying cash. That's our cash. And we're just buying it on a discount because of the ability to move quickly. And that's why I say all of those things factor into the way that we're writing. I'm very, very excited because people that were unwilling to take a discount a year or 2 years ago, and actually I realized there was a 20 something month period in which I didn't buy anything. It was the longest time in my 20-year career that I've never bought anything. And part of it was because I kept to my underwriting standards, and I wasn't speculating on these future valuations, and everybody else was. And I was trying to buy stuff, and I just kept getting outbid on stuff. And I was just like, I don't know how these people are going to make money. And I was just like, I pulled all my hair out. I don't know if you can see it on the video, but on the audio, you can't hear me. I have no hair. I pulled it all out going, what in the hell is going on? Well, how are people doing this? And guess what? Some of those people made tremendous amounts of money, but I just stayed disciplined to our underwriting criteria. And now a bunch of deals are looking much more appealing. And so then we can say, hey, I actually started talking. I was like, I think we're going to start having some opportunities to buy stuff over the next few years. And this is game on. Let's get ready.
You need to underwrite with the end in mind, right? You kind of need to underwrite, you have your actual numbers in the beginning, which you focus maybe on more of the future value of when you're stabilized your asset. So what are you using these days? Like when you're using your stabilized asset numbers, are you leaving a cushion? Are you for interest rate? Are you keeping it? Are you using the same interest rate for your stabilized refinance as you have to pay today? Are you using the same, what's the conservative cushions that you're leaving in for kind of like your rates or your cap rates? Are you not, normally maybe you'd be buying something on a, 9 cap. And then when you underwrite your stabilized value, it's at a 5 cap. Are you no longer, to figure out what your loan might be, because you have to do that when you're buying these commercial deals. You literally have to underwrite where you think your stabilized value is going to be, so you can kind of forecast out what your stabilized loan might look like, so you know what your stabilized cash flow looks like. And that all requires using interest rates and cap rates, right?
Yeah. And I say it's a dynamic thing. I look at, what if it takes us 20%, 30% longer to do the value add? And this is obviously the example of a value add. What if construction costs are 20, 30, 40% higher than what we anticipated them being? What if the interest rates are, so stress test and run a model on all of these variables. And then what happens is really what we want to get to is like, at what point do we lose money? What is the worst case scenario? Where does that factor in? And then it's like, well, this, and this would have to happen to where we're actually like starting to lose money. And if the probability of those is looking like it's somewhat realistic, then I was like, then we need to either pay less or maybe not do the deal. But if it's like, man, all of those things have to happen, a black swan type of event would have to happen before we lose some money, we may break even, or it may take longer. I like, so Blackstone, I was talking to some of the guys that are like, they've never lost money. And I was, really, you've never lost money? And they're like, we've held something for 10 years longer than we anticipated we were going to hold it. But we just waited until the market came back up,
Right.
and we sold it 10 years later than when we thought we were going to sell it. And so that's the benefit of real estate, is time can also be saving. A grace of saving is that as long as you have the ability to maintain or tread water, and as long as you're not losing money, and then that's why your underwriting, your due diligence becomes very, very important on all these commercial deals. So
you got to stress test, right? You stress test for all those factors, determine when you're going to start losing money, and decide where you're going to slice the pie up in there in that way. This goes for anything. This goes for you guys buying single family homes to flip, or BRRRR, or whatever else, right? Name of the game right now is runway. If you can just get into a deal where you have some runway, which then gives you options on your exit strategy, you're going to be picking up deals left and right, right? As long as you can get that runway with multiple exits, anytime you're doing deals, but now especially, and the sellers are willing to listen to that now. So how long do you think this is going to last, this pocket of opportunity, which we haven't even, it's only starting, it's starting to begin. It's starting, I think, to be like where the sellers are listening a little bit. I don't even think we've gotten to the bottom. What do you think?
I got advice from a mentor that he said, don't try to time the market.
Yeah.
I hear this and everybody says this, is don't try to time the market. If it makes sense for your business plan, you can move now as the market's going down or the market's going up. Is don't try to time it. Just, does that deal make sense for what you're working through? And obviously, the best deals we did were in 2009 and 2010, when the market was still falling and falling out, and it didn't bottom until 2012. I think this is a shorter kind of dip as far as overall the global economy is struggling as a whole right now. China is struggling. There's all kinds of political unrest with Russia and Eastern Europe, and energy cost and inflation, and everybody printed a bunch of money. And so there may be some greater macro forces that are at play that could lead to a elongated, bad period. But even you run those stress tests. I did this. I bought deals in 2019. I didn't model in an epidemic, let alone a pandemic, so like there's always things that you don't know, that are never happened before, potentially going. But if you look at history, 22 months is the time on average of every time the Fed has raised interest rates to when they start cutting interest rates. From the time they started till the time they cut was 22 months on average. Sometimes it's been out to 30 months. Sometimes it was been like 18 or 15 months, but on average, 22 months. So if you go back to when they started raising rates, and if, tracking the history of what the Fed does, is they tend to overdo it. They overcorrect. And what happens is then they start pulling back faster than they ramped up. And so if and where we are, we may be within a 12-month period or under of where they start lowering interest rates again. And so then if you may be buying something and have a 3-year rate lock or something locked in there, and you can go into permanent financing, it could be coming down. At least in the last 100 years, that has been the average of what has happened with the interest rates. And so there may be a next 12-month buying window of people and honestly, a lot of baby boomers that are owning some of these real estate or businesses or these other things that are just like, I don't want to deal with the pain of this. I'm out. And so that's why I think there's going to be quite a buying opportunity on almost all asset types in every single market. And then it just makes sure that you're doing your underwriting, your due diligence. But there's also a shift in office work. Office buildings are a tougher, nut to crack right now. I just saw in San Antonio, rack space was going from 1.5 million square feet down to 75,000 square feet. They're moving almost their entire workforce to.
Yeah. So many different components in the future of real estate that, I think about the historical stuff always, and I'm like, boy, it just seems that life is so different these days. There are components impacting how we would look at the future of real estate or look at these deals that weren't considered back then in the history, right? You kind of got to factor those in. Well, we could talk to you forever, Jake. That's for sure. I could go on and on with you all day long, which I would love to do, but we probably need to wrap it up because Joe needs to get out on his bike. That's the reality. We got to think about Joe here. So Joe, we're going to wrap it up. So Jake, what's the book again? And do you have a copy of it you can hold up there?
I do. It's Catching Knives, a guide to investing in distressed commercial real estate. You can find that on Amazon. You can find it on my website, catchknives.com. You can also find some of the other stuff that we're doing, Instagram, and my social media team has me on TikTok now. Actually, I didn't know that at first. And, they were like, hey, you're on TikTok. And I was like, I am? I was like, am I dance? Did I know about this? It's just repurposing some other content that I do out there. So jake.realestate on Instagram. I'm out there on, I think, most platforms. Jake Harris Real Estate. You can find me. And obviously that catchknives.com is where you can access the newsletter and courses and other things that we talk about frequently.
Awesome, guys. Now is the time. Now is the time to get schooled up. If you thought, I want to jump into multifamily commercial real estate or office or whatever you want to do, now is the time. Take that action. I think the theme of today's, show is take massive action, as the examples, especially with that guy down in Florida, can show you, right? You guys you're here listening. You know how to connect with people. You're surrounded by a safety net and a collaborative community to help you. So you have no excuses. Quit with the analysis paralysis and go take some imperfect action, fall forward, and let your community, such as Seattle Investors Club or anybody that's listening to the show, you know where to find me. We can, my superpower is that if I don't know the answer, I know somebody that does. I've been around a long time, right? Now I know Jake, right? So take action. Go for it. Take advantage of this fluctuation. And, we'll see you on the next one. Joe, where can everybody find the details of today's podcast?
Yeah, you can get to all the show notes at SeattleInvestorsClub.com/171. That's SeattleInvestorsClub.com/171. And guys, this was great info today. So if you liked it, please hit that like button, consider subscribing. We'd love that.
We would love much. All right, guys, we'll catch you on the next one, or we'll see you on a Thursday at our weekly mastermind from 11:30 to 12:30 Pacific time. You can grab the free Zoom link to join that conversation by just going to meetup.com and searching Seattle Investors Club and join the conversation, and we'll see you there. Adios.